Hi, it's Adam here, and I wanted to make a video and talk about what's really going on in markets and the global economy. There's so much talk out there, and I think so many people are wrong, and I'm going to explain exactly what's going on and why markets have been so roiled this year and why there's been so much misunderstanding. First, let's start with commodities. We are at the tail end of a 15-year super cycle in global commodity markets. So what does that mean? Well, prices, because of emerging market growth, prices were so elevated for so long that there was massive investment in commodities. Let's go back just a few years to say 2012. With elevated prices for virtually every commodity. What was happening at the same time is the Fed brought rates down to virtually zero, and so did almost every other central bank. So you have commodities that can be mined at prices far, far, far above cost. So you had companies going in and building more mines. It was very easy to raise money. The mathematics were very simple. For instance, in oil, when it was at $100 a barrel, I mean, if it only cost you $25 to get it out of the ground, you made $75 a barrel. And it was easy to raise money. Any company with a good idea really could raise money very cheaply. Now, this got very popular. And the problem in commodities and why boom and bust cycles are inevitable is that it takes a long time from when you invest the money to when you start getting the commodities out of the ground into market. So you get money from a venture capitalist, and then maybe 3 years later, I'm selling my copper, nickel, zinc, oil, whatever. So that money that was invested in 2012 at cheap rates at $100 oil is now just wanting to get repaid. Those companies are just starting to produce. And back then, you didn't know how many people were going to come to market. Everyone had the same idea because it was tough to make money elsewhere. So now you have a flood of supply hitting the market. And so many people have missed this. Yes, there are problems with demand. Maybe there are some hiccups here and there, but there's nothing sensational going on in demand. And that brings me to China. It's been embarrassing, really, how the Federal Reserve, just this week with Janet Yellen at Humphrey Hawkins, put the bulk of the blame on China. Whenever something goes wrong, it's so easy to blame China. It's such an opaque economy. No one really knows what's going on. The stock market is wildly volatile. And you can say it's uncertainty about China, this, that, or the other thing. The economic data from China, it hasn't deteriorated significantly. Sure, it might be a little bit slower, but growth at 6.5 instead of 7% isn't what's tipped the balance in all these commodities. It's the supply hitting the market. Demand, I think, in emerging markets is a problem. It's not, though, China. It's the commodity exporters. So the same people who are exporting these commodities saw prices bust, and those countries, Brazil's a big one, don't have the same demand. So you're faltering demand in places like Brazil, Indonesia, Malaysia, Saudi Arabia. Any major commodity exporting emerging market or developed market economy. So that's where we're seeing the faltering demand. It makes perfect sense because those commodity prices are much lower. We don't have any clarity. What you need from a central bank at a time like now, and in general as an investor, is some certainty about why this is happening. When you get these vague ideas about China, vague ideas about the Fed making a mistake. Yes, the Fed made a mistake. It was a mistake to hike. There's no inflation coming. This is the age of oversupply. But 25 basis points from the Fed, a little hiccup in China, they're not that big a deal. Massive commodity oversupply, oil falling from $100 to $26, that has consequences. That's much, much more disruptive than those small factors. And it's not necessarily going to be bad. This is good news for commodity importing countries like the United States, like China. But in the interim, you have so much disarray. Markets do best and economies do best when the rules of the game are relatively stable. When the equation gets turned upside down, you tend to head to the sidelines until there's some clarity. And right now, let's talk about the problem areas. Everything's getting tossed out, but here are the real bad areas. Commodity companies. Naturally makes perfect sense. High yield debt. So in a sense, it makes you want to get rid of, as an investor, you don't want to hold commodity companies at all because prices are so low. It's obvious. You don't want to hold their debt either. But debt tends to trade in packages. So high yield debt moves up together. So you don't want to hold any low rated commodity companies, especially, but any low rated companies at all, because the thinking is there's trouble, it blows up, it all blows up together. Now, so the next big question in the market, the question I'm struggling with as well, is how deep will these losses go? We know some economies will struggle, all the ones we talked about, but who else will be holding the losses? We've seen financial shares take massive hit, 25% Bank of America, Deutsche Bank way down, JP Morgan even down, Citigroup. There's an old joke that whenever there's problems, Citi is there. That they're always the ones holding the toxic assets. So perhaps they have derivatives on these commodity companies, or they're holding the exposure, or somehow there will be financial sector losses, because that's a conduit, right? And then of course, it's the commodity exporting economies we have to worry about, developed and non-developed. And I'm going to get to that in a moment. Areas that I think should be fine. This paradigm is so poorly understood. Like I said, everything is getting thrown out. But in that, good assets are getting thrown. I think American consumers are going to be fine. The jobs will be fine. Of course, there will be loss in the commodity sector, and that will spill through into other parts. But if we can get a handle on this relatively quickly, it won't affect the broader economy, and those cheaper commodity prices will be a boost to consumer spending. So you want to look at non-financial, non-commodity companies. So that's tech, that's consumer companies. A whole host of things fit into that in places like the United States, perhaps even places like China. Even better are commodity importing emerging markets, because again, everything's getting tossed out, but low commodity prices are good for some emerging markets, and they may be underpriced at the moment, and their currencies. So that right now, beyond that, I have two big questions that I'm struggling with. The first is whether markets are overstating the problem at this point. It's so poorly understood, and markets have perhaps gotten so irrational that, we don't really understand that it's probably just a commodity issue, commodity companies. It's not necessarily ring fence, but once it's understood, then there will be this less of a panic mode in markets. So perhaps we're already at the point where it's overstated, or maybe not. And along with that, I don't think this oversupply problem is overstated. So oil, I believe, will go much lower still. You have to think that probably filters through into everything the way it has. But on the flip side, even once it's better understood, then perhaps we won't see everything getting tossed out. It'll be more selectively priced assets. The second big question I'm struggling with is, how will developed commodity exporting countries perform? So I'd put in that category Canada, Australia, New Zealand, at least in a currency, those currencies in the currency market. Now, for certain, these countries are highly dependent on commodity exports. However, perhaps not as much as the market's stating. If you look at dollar CAD, for instance, at 146, you're priced in a recession at that point, chance of negative rates, perhaps a housing collapse, not collapse, but a housing decline, and some real pain in the economy. The question I have is, you had this 15-year bull market in commodities, and maybe we've saved enough in these countries that they can overcome, they can smooth it over, that these consumers aren't extremely over leveraged and they can ride it out. Governments have room to spend. This isn't the Eurozone where you have an economic contraction and at the same time you have governments forced into austerity. And that's you get these 9-10% economic declines in Spain, Italy, and the likes. That isn't the case in Australia, New Zealand, Canada. So there's some resilience built in that perhaps the market right now isn't fully appreciating. But again, when oil's at $15 or $18 and nickel and everything else is way lower than it is now, those risks become real again. So ultimately, what is driving markets is commodity prices. We had a 12% bounce in oil on Friday. That's so typical of a bear market, as you get these squeezes lower, death by 1,000 cuts, and then you get these pops, very quick pops. And I don't believe that's changed the story. Supply is the story, and it's the story in virtually every commodity. One exception I would say is gold. Gold, is funny, it peaked before other commodities, right? 2011, 2012, gold was hitting $2,000. And a lot of the supply has come out. Some of the world's biggest gold mining projects have been shut down. And I think where we're at today in gold is where we'll be in 2 or 3 years in the rest of the commodity market. And in the meantime, its defensive properties will boost gold and make it a great trade for the year ahead. But right now, central banks just can't be relied on. And it's deeply disappointing that they don't understand this paradigm and are instead just flippantly blaming China. So that is how I see it shaping up. And those are the big questions on my mind going into the rest of February and into March.